On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. G'day team, hope you're all well. That's the end of another week and wow, what a busy one it was. Lots going on, very, very eventful. So we will do our best to wrap up all of that and bring it together. Then let's turn our attention to what's coming up in the days ahead. Starting with global share markets, the S&P 500 in the US down another 2.1%, another difficult week. That came on the back of a weak jobs report, which raised the prospect of a sharper than expected economic slowdown. So the S&P 500 is down 5.7% from its peak, which came in the middle of last month, and it's been those high-flying sectors that have felt the brunt of the selling. The tech sector is down 12.8% over the past few weeks. Consumer discretionary, Amazon is the biggest constituent of that sector. Consumer discretionary has slipped 10.1%, and communication services, that's where Meta and Alphabet reside, communication services down 8.7%. So those three sectors, which have been the high flyers of the last 18 months, have all come off quite a bit. In contrast, healthcare, real estate, consumer staples, and utilities, those four sectors, have all risen over the last 4 weeks. So it hasn't been everything that is falling, but some of the stocks that have been falling are the ones that tend to be bigger because they're the ones that have got so dominant in recent times. Japanese shares were weaker still. We saw another interest rate hike from the Bank of Japan. We saw more strength in the Japanese yen as it continues to rebound. So the Topix index in Japan fell 6% last week. That's a big fall. And it's now down 13.4% from its peak 3 weeks ago. It still had a very good run over the last 18 months. And that's maybe why it has suffered more than most. Elsewhere, the FTSE 100 in the UK was down 1.3%, Europe was off 3.1%, and emerging market equities fell 1.0%. Closer to home, equity markets in Australia and here in New Zealand bucked the trend. So the ASX 200 was up 0.3%, the local NZX 50 increased 0.8%. That was our sixth weekly gain in a row. That's the longest winning streak we've seen since November last year. However, worth noting that a lot of the weakness in the US came during the Friday trading session, and our market was closed then, as was Australia. So we might play a bit of catch up on Monday morning and respond to some of that weakness we saw internationally. Interest rates fell further last week. In the US, we saw the 10-year Treasury yield decline from 4.2% to 3.8%. And on Friday, we saw the biggest daily fall in almost 9 months. So at 3.8%, the 10-year yield is at its lowest in more than a year. Those moves saw US Treasury bonds return 2.6% last week, having gained 3.9% since the end of June. So even though share markets are suffering at the moment because of that risk aversion, you're seeing interest rates fall and bonds or fixed income are performing well. So if you've got a bit of both in your portfolio, you'll be losing on the one hand but winning on the other. Here in New Zealand, interest rates were lower too. Our 5-year wholesale swap rate was down another 6 basis points. It ended the week at 3.8%. That's the lowest since August 2022, about 2 years ago. And you might see something similar on Monday morning across interest rate markets in this part of the world. We might fall too, as was the case in the US on Friday, because again, like the share market, our interest rate markets were closed when you saw all that action after the jobs report came out on Friday in the US. Moving on to some of those key releases we saw last week here in New Zealand, we got another edition of the ANZ Business Outlook Survey. This was for July. Headline confidence rebounded solidly after falling for 5 consecutive months, and inflation indicators continued to decline as well. So I think the reason you've seen a bit of a bounce is not because things have got materially better, but probably just a bit of optimism, a bit of sentiment around falling mortgage rates, and talk that the OCR might come down earlier than people might have thought before. With 3 really big central bank meetings, one from the Bank of Japan, they increased interest rates. That's their second hike in a row. The first came in March, and that was the first hike we'd seen in 17 years. It ended 8 years of negative interest rates, so the BOJ is moving to something that looks a bit more normal. I think that's one of the reasons you've seen the Japanese equity market very volatile. Investors just trying to get their heads around that new paradigm of rising interest rates after a long period of very stimulative monetary policy. Then we had the Federal Reserve last Thursday morning, and they left policy settings unchanged. So their key interest rate is still at 5.5%. That's where it's been since July last year, the same as the official cash rate here in New Zealand. However, Fed Chair Jerome Powell did signal quite clearly that the Fed could cut rates as soon as September, which is the next meeting. Markets initially rallied on that news. They were quite happy that a rate cut is imminent in the US. However, 2 days later, we got that weak jobs report, and then the rhetoric quickly shifted to one where investors are thinking, well, is that too late? Maybe the Fed should have cut rates at this meeting. So markets are now not only pricing a 0.25% cut in September, but they see a very good chance of a 0.5% move, 50 basis points, which is a big change from where we've been lately. And that's all on the back of that weak jobs report. The Bank of England then rounded out our central banking trifecta, and in contrast to the Bank of Japan, which hiked rates, and the Fed, which left rates unchanged, the BOE cut interest rates for the first time this cycle. So it cut its policy rate by 0.25%, which sees it fall to 5%. That's the first cut since 2020 during the COVID era. It was definitely a close one. The committee voted 5-4 in favour of cutting rates, so definitely finely balanced. And I think the Bank of England might just take its time from here. Markets see the Bank of England pausing at the next meeting in September before resuming that easing cycle in November. They did say in their statement that they were a little bit wary of cutting too quickly or by too much. So that's where we're at with the Bank of England at the moment. We had 2 big economic releases out of the US last week, and the first was the Institute of Supply Management Manufacturing Index, the ISM index. This was much weaker than expected. It fell to 46.8, which is the lowest in 8 months. 50 is your break-even level, so we're well below break-even. That's not anything new. The ISM has printed below break-even for 20 out of the past 21 months, but the details were decidedly soft. The employment index fell to the lowest since June 2020. And while the US manufacturing sector isn't nearly as big as it used to be, I think it's sort of 8 to 10% of the economy, it used to be 40 or 50% some time back, although it is still a closely watched barometer of economic activity. So now we're all awaiting the services ISM for the same period for July. That is out on Monday in the US, and we're hoping that the services sector is in better health. Then came the main event, which was the July jobs report in the US, the non-farm payrolls report. Came out on Friday in the US, that was Saturday our time, much weaker than expected. Just 114,000 jobs added for the month, forecast for 175, and more importantly, the unemployment rate increased from 4.1 to 4.3%. Markets had expected it to remain unchanged, but instead it jumped to the highest since October 2021. And at 4.3%, it's quite a bit above the low that we saw not so long ago of 3.4. That was the lowest we'd seen since the late 1960s. And since then, in a relatively short space of time, it's jumped to 4.3, which is quite a big move. And that does make markets nervous because when the unemployment rate starts to go up, it often keeps going up, and that can sometimes lead to a recession. There's this financial market indicator that they call the SAM rule, SAHM. It's named after Claudia Sam, who's an economist. And the way you calculate the SAM rule is you look at the 3-month average of the US unemployment rate, and then you compare that to the 12-month low of that same 3 months moving average of the unemployment rate. And when the difference gets to 0.5%, so in other words, when it's increased by 0.5%, that is a fairly good recession indicator. In fact, this indicator has been triggered 12 times since 1945, and every single one of those times we've seen a recession, and it's never given a false reading. It's happened 12 times in 12 recessions, so it's been very reliable. Now, that doesn't guarantee that the US is about to fall into recession. That is possible, but it's not guaranteed. Even Claudia herself has said that every cycle is different, and there are no foolproof predictors of the future, and this one is no different. However, it has been reliable in the past, so it's definitely something we need to keep an eye on, and it's something that financial markets latched onto. That jobs report really did get the market's attention, and it was what caused those big moves across interest rates, shares, and expectations for what the Fed will do next. Turning to the week ahead, there's a few things we need to keep an eye on here in New Zealand. Early Wednesday morning, we'll get the results of the latest GDT auction, the latest global dairy trade auction. 3 weeks ago, we saw some stability return, which was pleasing because at the auction before that, we saw the biggest fall since August last year. The headline price is up about 5%, 5.5% so far in 2024, but it's been a bit of a mixed bag. We've seen some products strengthen and other products weaken. So this will be something we'll be monitoring on Wednesday. Later that morning at 10:45, we'll probably get the highlight of the local calendar, and that will be the labour force report for the June 2024 quarter. Hopefully it's not quite as eventful as we saw on Friday in the US, but it will be closely watched. Our unemployment rate is sitting at 4.3%, same as the US actually. It's expected to rise this week. The Reserve Bank figures have it going from 4.3 to 4.6, whereas the economists out there have it going from 4.3 to 4.7. So 4.6, 4.7, that's sort of where expectations are. The bad news is that that's well up from the multi-decade low of 3.2% that we saw in early 2022, so 3.2 to 4.7, a big move, bigger than that move we've seen in the US, isn't it? But the better news is that at 4.7%, if that's where it lands, that would still be below the 25-year average of 4.9%. So not terrible, but no one likes to see unemployment rising because that means people are losing their jobs. This is also important because it's the last major release ahead of next week's Reserve Bank of New Zealand meeting next Wednesday. And the general thinking is that the RBNZ will probably wait until October or maybe November before they cut the OCR. But if there was anything that was going to tip their hand and cause them to move early, a proactive OCR cut, if you want to call it that, next week, it would probably be this report, a much weaker labour force report. So it'll be very much in focus. Something else I'll be watching here in New Zealand this week will be the Reserve Bank survey of expectations. This comes out on Thursday afternoon. It's based on the responses of 30 or 40 business leaders, economists, professional forecasters, people like myself, and it's an important way of monitoring how inflation expectations are developing. It's been headed in the right direction lately. We've seen the mean 1 year forward inflation expectation fall to 2.7%. The 2 year forward one has declined to 2.3%, and the longer term ones, looking at 5 years, 10 years, sitting about 2.2%. So that's important. Expectations tend to impact behaviour. So the Reserve Bank is always very conscious of where inflation expectations are. If people are expecting inflation to rocket ahead, their behaviour will change to preempt it. But if people expect inflation to be anchored and sitting around that 2% level, which is where they want it to be or where they're trying to get it to, then people will be more relaxed and they won't be out there sort of panic buying things, and then it becomes self-fulfilling and they drive inflation up. So this is important. It's out on Thursday afternoon, and it will be not quite as widely followed as that labour force report, obviously, but still something to keep an eye on. Across the Tasman, we've got a Reserve Bank of Australia meeting this week. Its decision will be out at 4:30 p.m. on Tuesday. I don't think the RBA will do anything. The cash rate across there is sitting at 4.35%. A bit of talk from some economists that they might need to hike rates again. But we got some inflation figures last week, a little softer than expected, and I think that gives the RBA a bit of breathing room. So rather than more hikes, I think they will probably just stay put for a longer period. Last but not least, the global reporting season will continue. Three quarters of the US market, or three quarters of the S&P 500 at least, have already reported results, and it hasn't been too bad so far. About 4 out of 5 companies have beaten estimates, and for the quarter, the June 2024 quarter, the earnings growth rate for the index in aggregate compared to the same quarter a year before that is tracking at an annual rate of about 11.5%. So that's not a bad earnings growth rate, the highest since 2021 and the fourth consecutive quarter of growth. Big tech is behind us. Most of those big Magnificent Seven companies have already reported, but there's still about 80 odd S&P 5 companies that are scheduled to announce results this week from a wide range of sectors. Some of the highlights likely to include Caterpillar, Costco, CVS Health, Disney, Martin Marietta, as well as across the Atlantic in Europe, Novo Nordisk. That's the largest stock in the Stock 600, which is a big European share market index. So that one will be closely watched too. And here in New Zealand, we are just starting to see the early part of reporting season kick into gear here in New Zealand and across the Tasman. It's still pretty quiet. It will get much busier next week. There'll be tons and tons and tons of companies to watch next week, both here and in Australia. But this week we've got Vista Group reporting, we've got Vital Healthcare reporting on the NZX in Australia, Mirvac Group, Transurban, the toll road operator, REA Group, and QBE Insurance. So plenty to watch. And then next week, as the international reporting season winds down even further, we will just start ramping up here, and there'll be loads of corporate releases to keep us busy. So been a busy week. Hope that is useful. Hope that puts a few things in perspective. Thanks for listening, as always, and we'll talk again soon.
For more insights, visit craigsip.com.